Hey party people, welcome to this week's Money News in Human Words. The first piece that I have for this week is about the US, EU and England headed for a recession, but apparently Australia isn't. Now, this comes from an economist that manages just over $100 billion who's forecast that interest rates will peak lower and start coming down sooner than what the RBA has forecasts, not the first person to call out the RBA for their forecasts over the last little bit. And there's a bunch of detail there. Essentially, last week, the Bank of England has conceded that Britain was facing a massive recession after they raised their benchmark interest rate by 0.5% to 1.75%. UK inflation is expected to grow at above a whopping 13% over the next little while. And talked about the fact that given that the Bank of England would raise interest rates by such a large amount, even knowing that the economy is already going into recession, tells you a lot about the priorities of the central bank at the moment. Because normally the central banks, if they feel that the economy is going into recession, they want to ease interest rates so that they can soften that landing. At the same time, we're seeing some people talking about the fact that the US economy could be reliving the 1970s experience where the Federal Reserve was raising interest rates, but they didn't raise it quite enough to get inflation under control. And what happened then was that there was slow economic growth, but high inflation, which is actually the worst possible outcome for the global economy. They talk about the fact that it's better for central banks to be raising rates faster, get on top of inflation, and then the economy can get back to its period of growth, knowing that there is some short-term pain there. So this fund manager economist, Redican is his name, he ascribed less than a 50% chance of a recession in Australia. And what he said is that he's thinking that his forecast is that the cash rate will increase from the current 1.85% to somewhere between 2.5% and 3% by the end of the year, where it will stop, which I think is good news for a lot of mortgage holders, with the RBA forecasting that things will go on a little bit more than that. He did say that he felt that the interest rates might be a little bit more volatile over the next couple of years, meaning that start to ease, but if we get spikes of inflation, that they could be jumping up quite quickly. And says that there's a lot of quite pessimistic expectations around inflation and quite optimistic predictions around growth. And if the opposite of that happens, in fact, if inflation starts coming down faster and growth starts slowing, that interest rates might start getting cut as early as next year. So wages increases are likely to come into play here, where a lot of people talking about wages increasing over the next little bit. That helps on the economic side. And look, I don't have a crystal ball, but my take is that he's onto something here, meaning that share markets and property markets are likely to recover faster than what the headlines would lead you to believe. Continuing that talk around markets now, and the question is, are we at the bottom of the market? Now, what we've seen is that historically, what has driven the share market to perform well have been low interest rates, low wage growth, low what's called capital intensity. So essentially where we've got lower tax rates and good supply chains that are particularly in the US that drive bigger profits for businesses. And what we're seeing over the last few weeks is that these things that normally drive economic growth are actually now hamstringing economic growth. So interest rates are rising, and we've seen that jumping up quite a lot. Big companies that was reported on Mirvac, one of the biggest borrowers in its property operations, that their borrowing costs have increased from 3.4% to 3.9%, which is a pretty big jump when you think about 0.5% on 3.4%. That's a big increase. There's also big inflation implications as well. what we're seeing is that companies in Australia, we've got a lot of resource companies that make a lot of money. What we saw, like Rio Tinto just took an earnings hit of $300 million US dollars because of rising inflation, means that they've needed to fund higher costs than what they were previously expecting. At the same time, we're seeing wage growth on the rise, where big companies like QBE have just put through 2 wage increases across the business. And companies are increasing wages because with the talent war, they're not wanting to lose people. And at the same time, supply chain pressures have meant that we're seeing companies, it's pulling back on profits, and part of it is more expensive costs for supply chains, and that's driving into inflation. But things like that you don't really think about, like companies are required to now keep more inventory on hand because they can't get to things fast enough. So like Baby Bunting had to put all of this extra stock on hand because it was previously having so many problems with getting stock that they couldn't sell. But that means that they have to actually put all of this money aside to go into the stock that they're selling, so that they're sitting on more capital, and that's slowing down their the growth and profitability of their company. So we're seeing taxes also on the rise, royalty taxes across Australia. And I think how these things impact the ASX reporting season, so the Australian companies, what they report and what happens from profitability, means that the pressure on corporates is likely to increase. Things are moving higher, and when profitability goes down on companies, it means that there's pressure on their share prices. So potentially, and I think that this earnings season is going to be a really important one when we look at what companies are doing as an outcome of these headwinds that we're seeing. But potentially, given that there is quite a lot there, it seems that we've still got potentially a ways to go on the downside before things start getting back on track. They have spoken about a lot of the things turning around reasonably quickly, so there's good news coming, but it needs to actually come. Talking property now, and we've seen, I saw a piece come out last week talking about the suburbs that posted the biggest gains through the pandemic and now suffering the biggest losses that we're seeing, particularly the seaside and tree change suburbs along the east coast of Australia. These markets really had massive gains through the pandemic, and they're now seeing the biggest turnaround. So I was looking at some CoreLogic data, and they found that the best 20 suburbs across Victoria, New South Wales, and Queensland posted gains of nearly 70%, 70% from March 2020 to February 2022, so less than 2 years, compared to the national average of around 25%. But these same suburbs are leading the post-pandemic fall as prices and rising interest rates really kick in there. There's some pretty blue chip suburbs on this list that are now suffering losses, and we've got suburbs like Newport on the northern beaches in New South Wales down 10%, Taran Point down 16%, Box Hill is down, Cornell is down 13%, North Narrabeen, Avalon Beach, that's where I live, that's down 10% in the same little period. And there's a bunch of other suburbs as well. Tamarama in the eastern suburbs down 12%. That these suburbs are really copping it now as some of the pandemic changes in interest rates kick in. There's probably an argument that these suburbs were a little bit overblown as a result of the property boom fueled by massively low interest rates, but we are seeing things turn around. Now, we have seen some permanent change in some of these areas with companies adopting formal work from home policies, but there has been a big dip. AMP economist, chief economist Shane Oliver has come out saying that the housing downturn could potentially be over in the next 12 months, much shorter than what we typically see in these property market downturns. But the reason for that is because the prices are falling faster than they normally have. So normally they're falling around the same level, but because the fall is happening more quickly, it means that the recovery could be coming much faster as well. it particularly, interest rates being a big driver of this. So Dr. Oliver saying that we could be getting to the bottom much faster, thinking that it could be within the next 12 months, potentially September next year. And already we're seeing some signs of recovery. Now, I'm calling out that this forecast has recently been updated. We're seeing this target is moving around quite quickly. And I think if forecasting over the last little while has taught us anything, it's exactly that these could change again very, very soon. We're seeing that the fastest rate of decline in the property market over the first 6 months since the 1980s, essentially, when the CoreLogic data started kicking in, which sounds bad, but it just means that the decline is over sooner. There's some talk that the recovery could be slower, but the recovery is coming. We all know that. And I think timing the market is impossible. So you don't want to be sitting on the sidelines waiting for the bottom, or it could have potentially, or it most likely will, pass you by. The next piece I wanted to cover, and this is a pretty interesting one, that we saw the new super fund statistics release, and that showed that there's 80,000 Aussies that have over $2 million in super, which is costing the budget a whole bunch of money in the tax concessions that super has provides. This list increased by 1,000 extra people joining the ranks of Australia's most cashed up super fund members. And interestingly, 700 people below the age of 40 now have $2 million in super, which is more than 40 times the median balance of working Australians. Interestingly, of the people that have more than $2 million in super, the average super fund balance was $3.8 million, 3.8 in 2019, 2020. There's actually 384 people below age 30 that have more than $2 million in super, and their average super fund balance is $5.3 million, which is a serious chunk of change. And what I think makes this most interesting is that 80% of the people in this particular group, in the under 30s group, either didn't lodge a tax return or earn less than $18,000 in 2019, 2020. So obviously it's the bank of mum and dad that's helping them crank this $5.3 million average super fund balance into their super. So pretty interesting. And other stats show that even though there's only 6% of Australians that have more than $500,000 in superannuation, 48% of the total value of personal super contributions, so super contributions from bank accounts, as opposed to salary sacrifice through an employer, were made by this group in that tax year. So it suggests that people are using super as a tax shelter. No surprises there. Obviously, the rules are set up for that. And look, they talk about this not being for the intended purpose of super, which probably is entirely true. But the worrying thing is that they're talking about, or suggested this think tank talking about the government changing the super rules again. And for me, I think there's no wonder that people don't have confidence in the superannuation system. Obviously, these are pretty extreme examples, and there's a pretty strong argument for that. People that have, $5 million in super maybe don't need as many tax concessions as people that have got 50,000 in super that are trying to save for an actual reasonable retirement. But when you follow the rules and then they change and change again, I think that people are right to bring into question, is super the right thing? Is that where we should really be putting our money? Because the government is just want to muck around with it when they need to grab a few tax dollars because they've been spending a bit too much money. A little bit of a off-topic thing, but talking about family trusts and the ATO crackdown on family trusts to save tax. Basically the ATO has come out and said that they will be looking at people that are using these trusts solely for the purposes of saving tax, but they have approved, essentially, rubber stamped a strategy that will save you $9,000 a year in tax. Now, there's a lot of people that using family trusts and using trusts to distribute income to, say, adult children that then give the money back to the trust, and it ends up back in the vehicle. And the ATO is saying that that's really like I don't think they called it tax avoidance, but it's a strategy that's set up in a way to just save tax, which they say that the trusts were not there to do that. So some of the valid reasons that you can use a trust, which includes some that save you an amount of tax, I thought it was worth just unpacking them. The first big one is asset protection. So when you put assets inside a trust, if you get sued, there is a level of protection there. It's not bulletproof, but there is a level of protection that protects your assets so that it's harder for someone that's suing you to sue the assets of a trust. Also, owning a business through a trust is another really important way that people can, one, protect assets, secondly, manage capital gains, and third, manage income and dividends that are owned through a business. Talking about having, family members bring them into a business, transitioning ownership to family members, children, whatever, over time, gives you a lot of flexibility. For me, I think that's huge from a flexibility perspective. Plus, if you sell a business, because you can distribute gains through a trust, it means that you can distribute gains to multiple tax-paying entities, multiple individual taxpayers, and use multiple marginal tax rates to pay less tax, essentially. Also, estate planning, there's a lot of tax savings that are available for this. You think of like people that are saving hard to provide for their family in the future. If you own a massive share portfolio in your personal name, and then you pass away and want to leave those assets to kids or your grandchildren, that your estate needs to pay tax to then pass that through. Whereas when you own through a trust, it's not quite the same, and you can sell down assets to then distribute gains for multiple people using multiple tax rates up as well. It means that there's a lot less tax. And the final reason, which is the one that can that essentially has been noted as I don't know if the ATO have said that they specifically approved this, but it's certainly on the list of things that they've said is a reason why you would have a family trust, is funding expenses for your children. So for example, if you earn $250,000 a year and you want to pay your kids some money to fund their university, housing costs, university fees, living costs, etc., if you distribute $75,000 to your kids, that will save you an average of $22,000 annually in tax payments. If you want to give them $20,000, the tax savings around $9,000 per annum. So every single year in tax savings as a result of following that strategy. I love trusts. I think they're great. They give you all of those benefits: asset protection, flexibility, estate planning, and tax savings to boot. So not for everybody, but they are getting cheaper and easier to set up. So if you're aspirational with your wealth goals, then looking into this and understanding if and when it might be right for you, I think is something that's definitely going to be worth a small investment of time and potentially a small investment of money. My last piece for this week is on meme stocks running again, which is frustrating a bunch of hedge funds and professional investors. Bed Bath & Beyond in the US has nearly tripled in a 9-day run. AMC Entertainment, the old market meme stock darling, is up 65%. And it's a reminder of the meme rally that saw companies like AMTD Digital increase by 32,000% in the last meme rally. Goldman Sachs have started tracking a basket of meme stocks, which is now up 17%, while the market is essentially sideways. And this puts hedge fund managers and investors in a tricky spot where a lot of them, when they see a company that they don't think is set for good performance, that they start to what's called short sell the stock. So they basically borrow the stock off someone else, sell it, and then they wait for the stock to go down, buy it at a cheaper price, and then give it back to the person that lent it to them. Called short selling. It's a little bit of a tricky market tactic to profit from the downside in a company. But what we're seeing is that like 50% of Bed Bath & Beyond shares have been short sold, and 20% of AMC Entertainment have been short sold as well. And when share prices start going up, what happens is that the people that have borrowed these stocks to sell them, that they're sometimes required to cover their position. So they have to buy back the stock at a higher price so they can give it back. And that further supports the market and makes it run faster. So we see, and I sort of laugh a little bit of this, thinking of the hedge fund managers, crying in their $15,000 suits as they have to rebuy stocks and not reap an enormous gain that they were anticipating. But it means that the markets can run quite quickly. There's a lot of money that can be made there, but things can turn around quite quickly as well and go back the other way. So a bit of a dangerous game. I think, yeah, obviously it's a pretty popular thing, but you want to tread pretty carefully with this so that you're not, going to blow up your cash. Guys, that's it from me for this week. Plenty happening. I will catch you on